Good morning. It's Wednesday, March 25th. Here's what's on the agenda. Cautious optimism as the US drafts a plan to end the Middle East war. Oil declines, but the energy crunch is already biting. And UK CPI crosses the terminal.
Let's have a look at these markets then, Lizzy. And it seems as if we have another day where we are weighing up escalation versus de-escalation. And de-escalation seems to be winning out in the views of the markets in the very near term. We see that in oil and we see that in futures as well. So the Brent crude price down by 4.2%. European futures up 0.9%. S&P futures up 0.6%. It seems that we are, as you say, the mood is perhaps a little cautious, but focusing on signs of de-escalation, and risk assets go higher. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. Markets heaving a wary sigh of relief this morning as the US has drafted this 15-point plan, as I say, to end the war in Iran. The art of the deal, it seems, has begun, Anna. But the question is how far this draft is from something that Iran could possibly agree to. And also, what should we make of the concurrent escalatory action that we're seeing and the signals out of the US at the same time?
Absolutely. So there are some signs of escalation. We have got continued fighting, for example. I mean, the Israelis talking about doing this with full intensity. Iran continuing to attack, certainly Israel overnight. And Iran not giving any sense that they are talking, not saying publicly at least that they are talking to the Americans or plan to talk to the Americans. And then we have the US ordering the 82nd Airborne, part of the army, into the region as well. And so you could say, is that all sign of escalation? But the market is very much focused on the de-escalation. You've mentioned this 15-point plan that people familiar are telling Bloomberg, and other media also have this story that is in the works. And what is also interesting is President Trump is increasingly telling a story of a battle won. And whether that is reflected by the facts on the ground, whether that meets with reality or not, is not necessarily the point entirely, because the market will take away from that he increasingly wants to be able to tell that story. And he's also talking quite positively about what Iran is going to be able to do in the Straits of Hormuz with regards to energy. We will see what transpires.
Yes, so you've got Axios reporting that the US and regional mediators are discussing possible high-level peace talks as soon as tomorrow, and Trump signalling that Iran had offered a good faith present, his word, worth a tremendous amount of money, and that's relating to energy flows through the Strait of Hormuz. So that helped add to that stock relief yesterday. Yeah,
and I'll just add one more when we're weighing up the de-escalation signs. I thought it was interesting as well that China is very openly telling Iran, asking Iran, negotiate with America. They, of course, lots of Asia, and we'll talk about this in a moment, lots of Asia very much caught up with this, at the forefront of this, and the economic fallout from the tensions from the war in the Middle East and the closure of the Straits of Hormuz. And so China putting pressure on Iran, I think, is an interesting dynamic. Should we think about how this is playing out for oil markets? Because oil, just like other asset classes, choosing to focus on the de-escalatory signs, and so we see oil prices are dropping. There isn't a great deal of change, though, when it comes to the Straits of Hormuz in terms of the number of ships getting through. There are a trickle, we understand. And Iran is introducing some interesting language here, talking about non-hostile ships being able to cross, those that are not supporting acts of aggression. They're also charging a transit fee to some ships, some vessels, as they try to use the Straits of Hormuz. And signs of the pain for Asian economies really mounting.
Yeah, so that fee of $2 million a voyage, we report, really making the world's busiest trade artery something of the Wild West, right, in the Middle East. And obviously even an informal toll is unacceptable to Arab producers in the Gulf, because it raises questions of sovereignty and weaponization of the route. But you mentioned the APAC region feeling that crunch especially hard. You've got South Korea stepping up contingency planning for a worst case scenario in terms of the oil shock. The Philippines declaring a national energy emergency. And the last time it had a national emergency was COVID. The president saying that urgent measures are necessary. They could ground planes. That's a distinct possibility, they say. And then in Australia, you've got hundreds of service stations reporting fuel shortages.
Absolutely.
And this could come to us in Europe soon. The Shell boss warning at CERAWeek that Europe's going to soon experience the same kind of disruption that you're already seeing in Asia.
Yeah, absolutely. And so we're just adding to the list, we have fuel purchase rationing taking place in Bangladesh, in Thailand and in Myanmar. We have work week limits in Sri Lanka. And so, yes, it's not a surprise then perhaps that Rahul Sarwan at Shell is saying, look, what we're seeing in Asia, not necessarily the detail of it, but certainly the mood it creates and some of the policy initiatives perhaps will be making their way over to Europe. And certainly he's suggesting that there could be a fuel squeeze in Europe. Chevron actually talking about what he sees as a pending crisis in California. There are other issues there. There's a conversation about regulation, but he's talking about California, and we remember that state imports a large amount of its refined product from Asia. So there are going to be links. This is going to be going global.
Now, in terms of the economic impact in Europe, we've just had a snapshot of the inflation picture here in the UK with the CPI numbers crossing the terminal, bang in line at the headline level for February. 3%. It's the same as last time. It's exactly what was expected. At the core level, though, it is a beat. So 3.1% was the number in January and the expectation for February. 3.2% was the actual number. Services, actually a miss here. A beat. Excuse me. So it was 4.4% before, 4.2% was the expectation, 4.3% is where it's come in. Of course, we're going to wait for the gilt market reaction. We'll wait for whether this does anything to Bank of England bets. I doubt it'll do much, but the pound weaker, 0.1% at $1.33. I should say this is backward-looking data, so you'd expect March CPI perhaps to be higher, particularly as that impact of higher gas prices feeds through.
Absolutely. I mean, yes, so to some extent the market possibly will shrug at this, but if it does show any signs of an underlying inflationary dynamic even before what took place in Iran took place, then that perhaps will be interesting. It also comes in a week where we have already seen and heard signs and signals from, for example, the PMIs yesterday that suggest that inflation pressures are building in the UK. That won't be a surprise to anybody, but interesting to see the extent of that. So on the manufacturing side, out of the PMI data yesterday, we saw the biggest increase in terms of the manufacturing side of the economy, factory gate price inflation, the most since 1992, input inflation, 1992. That is the most in more than 3 decades. That compares to Black Wednesday and when the UK dropped out of the ERM. Now, manufacturing is not a big part of the UK economy. It's very much about services. So the overall inflation picture will not look that dire and that stark, but that is certainly something we keep in mind.
Yeah, the general picture from this raft of PMIs we got from around the globe yesterday is declines in growth and higher prices. Interesting warning from Larry Fink at BlackRock to the BBC that if oil hits $150 a barrel, it would trigger a global recession.
Yeah, absolutely. And if that's getting into the sort of Main Street conversation, that is of interest. Let us tell you what else is coming up in the programme then today. We are going to be talking about markets, of course. Natalia Lipakina will be with us, JP Morgan Private Bank EMEA Equity Strategy Head. So that conversation at the start of market trading. David Luboff will be with us from KKR, APAC Co-Head and APAC Infrastructure Head. A lot of enthusiasm, of course, for investing money into infrastructure needs in APAC and plenty of other regions, data centre build-outs and all kinds of other infrastructure requirements. But how does that meet with the reality of energy issues and energy shortages within Asia? We'll certainly talk about that.
Let's take a look at what else we're watching throughout the day. We have the ECB and its Watchers Conference taking place in Frankfurt. Christine Lagarde speaking at 8:45 a.m. UK time, and we'll bring you her comments then. Then at 9 a.m. we have the German IFO business climate data. Before at 12 p.m. London time, the Bank of England's Megan Green will be speaking. We'll also hear later on from the Fed's Stephen Myron. And then in terms of US earnings aftermarket, we'll get numbers from Jefferies. But really interesting to hear what Lagarde has to say a week on from the ECB rate decision. I wonder whether she'll be any more hawkish. When you listen to the incoming VP, Boris Vujicic, he becomes VP, of course, on June the 1st. He very much was keeping his options open, saying the April meeting's a long way away. It's a long time in economics until then, and so much could happen.
Yeah, absolutely, so much could. And there's talk of, and he was referencing this, being asked about stagflation and the risks. It's not the base case, of course, for the Eurozone in his his view, but he does say that the risks are rising around stagflation. It's interesting, though, given the conversation that's taking place in wider central banking circles about how long you wait before you act in this particular scenario. And I'm drawn to what we heard from Hugh Pill, talking about the fog of uncertainty can't be an excuse for not tackling inflation, which sounds like pretty hawkish language that suggests central banks, perhaps scarred by what happened in 2022, perhaps scarred by what happened earlier in 2020 as well, this sense that maybe they'd waited too long in the past and they shouldn't do that again.
And if you wait too long, do you have to move in bigger steps in terms of the hikes? And does that have a more damaging effect on the euro area economy?
Yeah, but if you act too soon, do you risk doing damage when you can't open the Straits of Hormuz with an interest rate hike? But all of these conversations, no doubt, will continue. 10 minutes past 7 here in London. Here's what else you need to know then this morning. Bloomberg has learned that Citadel Securities posted a record $12.2 billion in trading revenue last year as the market-making arm of billionaire Ken Griffin's empire continues in its bid to compete with the largest trading desks globally. The result marks a 25% increase from the previous full-year record. Citadel capitalizes on market turbulence, stepping in as a liquidity provider during dislocations like those triggered by shifting tariff policies and, of course, geopolitical conflicts. The Information is reporting that SpaceX aims to file for an initial public offering, an IPO, as soon as this week. The report says Elon Musk's company could try to raise more than $75 billion. It had been expected to raise as much as $50 billion in a record-setting IPO that could value the space exploration company at more than $1.75 trillion. ARM is set to begin selling its own chips for the first time, aiming to generate about $15 billion annually within 5 years. The UK-based company expects revenue from the new chip business to eclipse sales from its current operations, which focus on selling intellectual property. Meta will be the first major customer for the company's chips.
Coming up on the programme, we'll bring you some of our exclusive interview with Rene Haas, the CEO of ARM, as he lays out plans for the company's new AI chips. Plus, we'll take you live to Frankfurt as Christine Lagarde makes a much-anticipated speech at the ECB and its Watchers event later on this morning. But up next, we'll be joined by Antonio Garcia Pascual, Head of Global Economics at Santander CIB. If you've got any questions of your own for our guests, please do send them to us on IB plus BB TV Go. Good morning from London. This is Bloomberg.
I don't like to say this. We've won this. This war has been won. The only one that likes to keep it going is the fake news. I mean, the New York Times, you read the New York Times, it's like we're not winning a war where they have no Navy and they have no Air Force and they have no nothing. And we literally have planes flying over Tehran and other parts of their country. They can't do a thing about it.
President Trump speaking to reporters at the White House, where he said the US and Iran are in active negotiations. Bloomberg understands the US has drafted a 15-point plan to help bring the war with Iran to an end. We're told the plan has been delivered to Iran via Pakistan, but details remain unclear. Let's see if we can get any further in this conversation then with Bloomberg's Jumana Basechi in Dubai. Jumana, good morning to you. It's interesting to me that President Trump has gone so far as to use that kind of language, that calling this a win now. Are we closer to working out who it is that the US are talking to and therefore what chances of success these conversations will have?
Well, you just played a little bit of what President Trump said yesterday, and later on he went on to say that their leaders are gone, there's no one to talk to, and then added, but they are talking to the right people. So it's still unclear at this point who exactly the US is engaging with on these diplomatic efforts. But what we do understand from our own reporting is that a 15-point proposal has been submitted to the Iranians via Pakistan. This 15-point proposal is very similar to some of the terms that the U.S. had set out prior to the war even started, reiterating some of the key points, a commitment not to pursue nuclear weapons, dismantling of key nuclear sites, limited missile program, and abandonment of proxy funding. But there is one new element, and that is the U.S., of course, are insisting on a full reopening of the Strait of Hormuz. Now, we have not yet got an official response from Iran or from Iranian officials, and if anything, the commentary that has come through the last couple of days suggests that no direct negotiations are taking place. But we understand that Pakistan are putting themselves forwards as a potential place for the two sides to meet should there be a physical meeting. And the Wall Street Journal are reporting that, if anything, Iran have actually hardened their stance in terms of what they're looking for, in terms of asking for additional assurances that the U.S. will not attack the region again. They're asking for a full withdrawal of U.S. from bases in the region, in addition to a new proposal, which is that Iran would like a new setup where they can apply and ask for fees for any ships that are transiting through the Strait of Hormuz. So this sounds more like a wish list as opposed to something that would be acceptable to U.S., to Israel, and of course to the Gulf states. So this is where we are. There seems to be a lot of daylight still between the two positions. And at the same time, let me remind viewers, it is day 26 of this war. Things are once again not really de-intensifying. Even Caroline Leavitt, the White House press secretary, said that Operation Epic Fury is continuing at full intensity. Ongoing strikes from the US and Israel onto Iran. Iran continue with their counterstrikes. And another big front also is opening up in the southern part of Lebanon, with the Israeli defense minister saying yesterday that they are looking to establish a more permanent presence in the southern part of Lebanon, accounting for about 10% of the country. And so from a military perspective, operations also picking up there too.
Germana, we appreciate the update. That's Bloomberg's Germana Basechi in Dubai. Well, oil is lower and stock futures are gaining on both sides of the Atlantic as investors bet that this Middle East conflict may begin to ease, tempering concerns over prolonged disruption. Let's look at the economic impact now. Joining us for more is Antonio Garcia Pascual, Global Head of Economics at Santander CIB, who's in Frankfurt for the ECB and its Watchers Conference. Good morning to you, Antonio. I wonder what approach you think President Lagarde is going to take when she addresses this conference today.
Yeah, it's kind of short before the, following the meeting of the ECB. So it's probably the message will not be too different from that she delivered a week ago. I think they want to keep all options open. We were discussing just before, the 15-point plan. So I think unpredictability it's extremely high. So I think options will be kept open. I think the signal of last week, signaling that the risks to inflation are tilted to the upside. Usually they don't do that. They only put the risk on growth, not on inflation. First, and second, the fact that they came up with this, not only the adverse, but the severe scenario, also is a signal that they're ready to act, and they're considering very severe scenarios. But I think, given this uncertainty, keeping options open, probably wait and see, as this is extremely volatile.
Well, given those signals and scenarios, I was going to ask you how live April is, because I think you think the ECB will be on hold throughout 2026. So what would change? What would have to change for you to see a hike this year?
Right. I think the key issue here is the duration and the severity of the conflict. Look, to see second round effects, it will take a lot of time. I don't think they will have the luxury of waiting for the second round effects, because this simply just take time. Maybe some of the indirect effects into, other sectors other than energy. But I think the key will be what you alluded to, the duration and the severity, and that's what we always have to go with. So if this extends beyond 2 or 3 months, right, where there's more destruction of capacity and infrastructure, then they will have to act, and that will be the key information that will go as input into that decision. So if you see a bit of easing of the conflict, right, financial conditions are already tightening, that's doing the job for them. So in a scenario in which things ease into April, I think April will be out of the question, and maybe they get away without acting. That's their adverse scenario. If we move into something that looks like their severe scenario, think about 6 months or longer with oil at over 120, surely they will have to act, right? And they will have to act not just with one, but with several hikes, probably in the order of 3, which is kind of what the market is pricing. The market is sort of hinting at this severe scenario. But I think you need to see the key input into that. Of course, there will be some macro inflation data, but it's the duration and the severity, looking at issues like destruction of infrastructure. That's what we will have to go with.
Antonio, good morning. I wonder how psychologically you think the ECB is influenced at this time by the previous spikes up in inflation that we've seen. Because earlier on this decade, when we experienced high inflation in Europe, a lot of central bankers hadn't seen that for quite a long time, whereas now there's a lot of recent history. Is that going to influence the reaction function, do you think?
I think a little bit of psychology is inevitable, right? There is a bit of a sense among the central bank community, including Europe, is perhaps they act a little bit too late. So I think that's the other side of the coin, right? So on the one hand, they will be willing to wait because of the uncertainty, and when things are uncertain, you want to have sort of more observables, things that you actually can see and monitor. At the same time, that's the tension, right? Acting too late. So I think it will play a role. All in, I think what this means for the next meeting for April, I think my view is they will tend to wait. If things get worse between now and then, they will signal strongly, and with a new set of projections, they will act in June. If things get worse or, not any better between now and April. I think but certainly your point is valid. There'll be some that will be a little bit more anxious to act, as we have heard after the last week meeting.
Yes. And Antonio, are you making any assumptions on the growth side about any rationing of access to energy? Because we see this in Asia already, and then we heard from the Shell boss yesterday that this same dynamic will come to Europe in some form. Are you making any assumptions that growth will be hit by reduced access to energy?
Yeah, I think, look, it's not only inflation indeed. I think growth will be an impact, not just because of for some countries more than for others, right? There are some countries in Europe that will depend more on, for example, gas. Think of the UK, think of Italy in the euro area, right? And if you were to plot sort of in the bar chart which countries in Europe will be worse off, clearly the UK is one of them. Obviously, within the euro area, Italy. But other countries, like take France, take Germany and Spain, perhaps a bit less so. But certainly it's an issue. In that severe scenario we discussed before, we do see that the euro area as a whole probably will be around 50 to 60 basis points lower growth. For the UK, that number is more like north of 1 full percentage point. So I think indeed growth will be affected. This is not just an inflation story in the severe scenario.
Well, how hard does oil have to climb for a global recession to start creeping into your base case? Larry Fink at BlackRock says $150 a barrel.
Look, if you start thinking about the different regions, right? You discussed before Asia that you alluded to, but take also the US and the Americas, right? The US is a net exporter, right? So if in a scenario in which oil is between 100 and 120, then the US growth probably will not be very much affected, neither for the rest of that continent. For Europe, it's a different story. If you're thinking of a further, more severe scenario in which this lasts longer, there's a lot of disruption to capacity, I think it's not just the oil price that can spike higher, it's the duration of that oil spike, how long this will be disrupted. And as you alluded as well, what is actually there's some shortage and capacity. Will the US, limit some supply of natural gas to Europe because whatever geopolitics? These are the type of disruptive scenario that you need to think of. And then anything else that we are not seeing right now. What if there's another aspect related to credit or private credit, some problems in the financial sector that we are not witnessing because the banking sector is far stronger than now. So, but things can get non-linear, right, in ways. And this is the kind of things that we're not very good at predicting and could actually come into the picture in that scenario of prolonged oil prices.
Antonio, thank you very much. Antonio Garcia Pascual, a global head of economics at Santander CIB. And we will hear from Christine Lagarde a little bit later on. And it's interesting in itself to see whether her thinking has changed with another week of war under our belts versus what we heard from them last week.
And whether she takes the opportunity to sound hawkish and do exactly what Antonio was just talking about. Let the market tighten financial conditions so that the ECB doesn't have to. Yeah,
you're wondering in the case of the ECB and the Bank of England to what degree the market is doing their work for them and what that results in terms of actual tightening. Coming up on the programme, we'll talk about technology. Arm unveils plans to start selling its own AI chips. We will bring you some of our exclusive interview with the CEO, Rene Haas. If you're wondering where Tom McKenzie is, all will become clear next. That conversation coming up shortly. This is Bloomberg. Welcome back, everybody. This is the opening trade. It is Wednesday, the 25th of March. And once again, we find ourselves on a day where it seems as if we're weighing up de-escalatory news flow with a little bit of escalatory news flow. But the de-escalation seems to be winning out in terms of markets and their risk appetite. So oil prices are considerably weaker. We're down by 4.4% on Brent, back down below $100 a barrel. And you see the effect of that on stocks. Euro stocks 50 futures then, Lizzie, down by 0.8%. So
futures higher. In a similar mood, you've got a bit of a rebound for bonds on the geopolitics. Yields down across the curve here in Europe. The German 10-year yield down 3 basis points. More pronounced moves, I should say, at the front end of the curve. And now Treasury yields steady on both the 2s and 10s.
Let's talk about tech then. ARM will begin selling its own chips for the first time, adding a business that it expects to generate about $15 billion annually within 5 years. This is a huge reshaping of this business. The CEO, Rene Haas, spoke to Bloomberg's Tom McKenzie exclusively about the new product and its aggressive sales goals.
It is a very big day for ARM. There's no doubt about that. We've been an IP provider since we started. We started selling compute subsystems a few years ago, which was sort of the next step, but it's not a physical thing. But as we grew into the CSS business, we had customers that kept asking for more and more and more. And here we are today with ARM's first chip product, the ARM AGI CPU, which Meta is our lead partner for, and Meta asked us to do it with them. So we did.
Talk to me about Meta and the partnership then. One of your customers, OpenAI, also a customer. What are the commitments from Meta, from OpenAI to take this chip on board? When do you start shipping?
So as Mohammed said, it's available now, and we'll start shipping at the end of this year. We're not saying anything publicly about the volumes associated with it, but they are material enough that we have to start talking about the product because it's going to start showing up on our revenue this year.
The revenue starts showing up this year, and in your presentation earlier here in San Francisco, you talked about potentially just this one revenue stream, just this one part of the business, potentially $100 billion by 2030. Talk us through how you get to that $100 billion.
So we're looking here then, Tom, at the general purpose CPU TAM, which today in 2026 is about $60 billion, $70 billion, depending on your maths. I talked about agentic AI driving a 4x CPU workload even today. So $60 billion going to $100 billion by the end of the decade in terms of market opportunity is not really that much of a stretch.
How much of this is about that huge demand we're seeing, particularly here in Silicon Valley, for agentic AI? How much of this is aligned to that shift?
I think you have something key that's underpinning everything, and that's the demand for compute, period. And compute has been perceived in AI about just generating tokens. But those tokens need to be distributed, managed, orchestrated, scheduled. That's all work that only CPUs can do. So the more and more compute that drives agentic AI drives huge, huge CPU demand, which is great for the product we just announced today.
The other number that you announced was $1 trillion, and that's the entire business by 2030. You were a $4 billion revenue company in 2025, and you're looking at $1 trillion potentially by 2030. Just unpack that for us. How do you get to $1 trillion potentially by 2030?
Yeah, so what I showed there was a TAM, total available market, of $1 trillion by the end of the decade. And I showed a picture that had some other die photographs of things that we could do with the tagline, we're not stopping here. So more to come, but today is all about the ARM AGI CPU.
More to come. So you have the pipeline of CPUs. Do you move into GPUs? What else is involved in more to come?
The compute demand for AI is off the charts, and ARM is at the heart of literally every AI compute workload. So we have a lot of different ways to go address that.
ARM CEO Rene Haas speaking exclusively there to Bloomberg's Tom McKenzie in San Francisco. Let's get some analysis now, shall we, with Bloomberg's senior strategist Neil Campling. Neil, how fundamentally does this announcement change ARM's business model?
It doesn't just change the business model, it transforms it. It's transformational. To give a sense of the kind of numbers they could make from this particular new product, they are moving from licensing software, which they've done so well for the chips over the life cycle. Now they're talking about manufacturing their own chips. We're looking at a potentially 100-fold increase in the revenue from manufacturing their own chip compared to licensing that chip. So it's a massive, significant shift. And we've seen, ARM has been at the forefront of technology for 20 years. They are really the core technology behind the Apple iPhone and the whole smartphone industry. So they can do similar things in terms of CPU, GPU, agentic AI. The 1 trillion TAM that he's talking about, the CEO, by the end of this decade. I mean, that's a really realistic target for how big this market could be, I think.
Yeah, and it seems as if the market gives this a thumbs up. Certainly after hours, we saw the share price go higher, Neil. And they went to quite great lengths to explain and give detail as to why they're doing this. So as you've already suggested, it's a big reinvention of the business. And in terms of the percentage of the sales price of any particular chip that's sold that goes to ARM, they tracked through from licensing to royalties to now making their own chips. The percentage is just so much higher the further along that chain you get, and that's what this is about. It's about trying to get more of that profit to ARM.
Absolutely. I think the example that was used, if you're looking at a chip that costs $1,000 as the example, traditionally they would have taken $5 of that $1,000 from licensing the technology to their partners. They're now talking about generating $500 of that $1,000 chip. So on that ARM ecosystem, companies that clearly benefit, apart from ARM themselves, are the manufacturing partner, which is TSMC, as they are also for NVIDIA, and the other players in that particular market. So this is a significant step change. And I think already I've noted this morning there's quite a few analysts that are coming out with very bullish projections, even more bullish than the ARM CEO himself.
So moving along the supply chain then.
How much is it about China? If they're trying to take on AMD and Intel, but as a UK-based company, they presumably wouldn't face US export controls. Surely they stand an amazing chance in the Chinese market.
Potentially, absolutely. It's difficult to know how the controls will limit or not some of these chips. But obviously, if you're manufacturing those chips yourself and they're coming from Taiwan into the Chinese market, that potentially could be an incremental advantage to them relative to, as you say, those peers in the US that often are having to use lagging technologies rather than leading edge technologies because of those export controls. And so if ARM as a UK technology champion could have an incremental advantage versus those peers.
And the CEO certainly making that point yesterday, saying that China could be a very good market for these new chips. There's no reason its chips can't be sold in China. They've got no Chinese customers at the moment to announce, so unlike Meta, that's not a sort of, there's no launch customer there, but they say the new chip does not trigger export controls, at least in their current form. We will see how that develops. Let's talk about other themes within the tech space there, Neil. Amazon, they have announced some new AI tools, and that's caused a bit of a sell-off in some other tech names. Is this proof that the AI scare trade continues? We got very animated by all of the things that other AI tools were going to provide and the competition that was going to bring to software, for example. So is this Amazon tool something to be feared by others?
Look, we look at Amazon, we look at the size and scope of AWS. Is an absolute gigantic monster, if you like, in this particular space. Now, they had partnerships themselves with OpenAI, with Anthropic, the other agentic leaders. So if AWS are able to leverage the AWS platform with agentic AI tools, then absolutely this has to be a real concern for many of those specific tools that some of the software companies have. And that's why some of these thematic software baskets gave up all of those recent gains again in terms of the market in the US yesterday and Asia overnight as well. It's a big concern for those players who don't have that scale.
You've also got Apple planning an AI reboot with Siri. What's the thinking there?
To be honest, it's difficult with Apple. We don't know. They're very sort of secretive. However, let me ask the question. Do you either use Siri significantly? Because I know I don't, because it's just not good enough.
Our producer does. She's often talking out loud to her phone in the middle of the office.
There are people in my house who use it, but
it's not the best, is it? I mean, Siri needs some major improvements. But Apple often is not a leader, okay? Apple often has the best platform technology to the all-embracing ecosystem, but it's often a fast follower rather than setting the new technologies. So we shouldn't rule out Apple's potential in this.
It's interesting because Apple was all about getting rid of buttons, I remember, recently, and now they're talking about testing this standalone Siri app, Ask Siri, with a button for iOS 27. So we'll see how confusing that turns out to be. Thank you very much, Neil. Thanks for joining us. Bloomberg senior strategist Neil Campling with the latest on some of those tech themes. Sticking with the technology news flow, the electricity needs for the development of AI is now coming into conflict with the unfolding energy crisis caused by the shutdown of the Straits of Hormuz. Microsoft's president, Brad Smith, spoke with CERAWeek in Houston about how the firm is managing soaring electricity demands for the tech industry.
What we launched on the 13th of January was what we called the Community First AI Infrastructure Plan, based on 5 pledges. And the first is that we'll pay our way for electricity so that our data centers don't raise electricity prices for the neighbors. And that obviously means working early on with utilities and with those that will generate power, doing that oftentimes, as we've done in many places, by proposing a higher rate on ourselves or on the class of data centers, so that those rates are high enough for us to cover the cost of our own electricity. It means investing with the utilities on improvements in the grid, say substations and the like. It takes a broad-minded approach, in our view, if we're going to pursue a sustainable strategy. You can't go into this and say, hey, I'm going to win in this city or town tomorrow without a regard for what we need nationally and even globally over the next decade.
That was Microsoft President Brad Smith there, and really it speaks to a problem that the AI boom is kind of clashing with the Iran war, right? Because you've got surging energy costs threatening to make data centres more expensive to run, and we're going to be speaking later on in the programme to KKR, who are really investing into tech infrastructure.
Yes.
And is this just the worst moment to be doing that? I doubt they would say so.
Right, yeah, absolutely. We'll get into that conversation. But yeah, there is this reminder here in this conversation that even before we were talking about supply constraints on energy markets, we were talking about increased demand. So the supply constraints produced by the Iran war fall into a market, into a global demand environment that is already being stretched by AI. And that's something that we've seen in the States, and that was a US-focused conversation, and it's been quite at the forefront of the US cost of living conversation, if you like, ahead of the midterms. It's not really been a feature of Europe yet, the competition between consumers and data centres for electricity. But that, if we are seeing further restraints on our access to supplies, that is something that perhaps is coming our way.
We're still ahead. Warnings that fuel shortages unfolding in Asia could soon hit Europe.
It's a ripple effect, Dan. We see, of course, South Asia first to get that brunt. That's moved to Southeast Asia, Northeast Asia, and then more so into Europe as we get into April. And so we are trying to work with governments to just alert them to the various levers they will need to pull, including on the demand side, including what they need to do around storage, what they need to do around purchasing stock, and so on and so forth.
The Shell CEO also speaking there at CERAWeek, and we'll discuss more on the energy outlook later in the programme, so don't go anywhere. This is Bloomberg.
You're still in this high velocity phase of the conflict, and as a result of that, there is a case for being a bit more defensive. So we've been defensive, we shifted defensive pretty much a week after the conflict started, and I think the challenge you have is stagflationary shock.
That was Christian Müller-Glissman, head of asset allocation research at Goldman Sachs, speaking about stagflation risks just a little bit earlier on this week, 7:47 then here in London. So coming up on the start of the European trading session, let's talk about these markets in 3 minutes. Our Markets Live executive editor, Mark Cudmore, joins us now. Mark, we have a futures picture for Europe that looks pretty positive, for the US also looking pretty positive. And yet we cover day in, day out, it seems, headlines coming from Asia that talk about restrictions restrictions on daily life in some form to try and save energy, reduce demand, restrict access to energy products, or as a result of restricted access. Is there some sort of global disconnect about the severity and the immediacy of the impact that this energy crisis is going to have on the global economy, do you think?
I think that's a great way to phrase the question, Anna. Good morning. I think that you're right that we are consumed at the moment with the headline trading to superficial marginal development, missing the fact that, as Christian there in that clip outlined, we have a clear stagflationary impulse from this month. Even if the Strait gets opened up in the next week or two. By the way, I think there's very low probability of that happening, but even in that optimistic scenario, you still have a supply chain disruption, an energy shock, an inflation shock coming through. It's not just an energy, it's oil derivatives problems. So we still have a stagflationary impulse coming through. We have higher yields and a demand destruction. Now, how bad it is still in doubt, but we seem to be so consumed by trading the marginal, Truth Social post from Donald Trump that we're not looking at the kind of the change in fundamentals. Overall, I'm seeing little particularly positive. Markets are trading more positive today than 24 hours ago. I don't see why. I don't see anything that's particularly changed for the positive. From a week ago, we've got more energy infrastructure damage. We've got the Strait still largely closed. We have Iran asserting more control over it, and Trump even acknowledging that via his threats. And we have the US trying to amass major troops for the weekend. Now, I don't know what they're going to do there. I don't know if they know what they're going to do, but certainly they're giving themselves the option of preparing for a major invasion, a major escalation. To me, everything is much worse than a week ago. And while it's already been a very, very bad month for global stocks, I am still very bearish today.
Mark, do you expect much gilt market reaction to that UK inflation data? Obviously, it was pre-war. It came in bang in line with expectations, and yet you saw services inflation hotter than expected. In general, when you look at the yields picture, does the damage just get worse from here, given your pessimism on the war?
I think, unfortunately, so first of all, to answer the immediate question, I don't think that inflation number matters too much. People are trading the war. In fact, everything is one trade at the moment, sadly. It's just like, what beta do you have to how oil trades? So everything is really an oil trade. But I do think it emphasized the picture that many nations had a high inflationary base before this stagflationary impulse. The dynamic we're trying to trade in rates markets is, when does an inflationary impulse become more of a growth concern as the disruption extends? I do think we're not yet in that phase yet, because we don't know how high oil prices will go or how long that they're going to stay elevated. So I think, unfortunately, I think rates will maybe overreact again, and I say that word overreact in the short end, in terms of they can spike again, even if we may not get all the hikes that get priced actually delivered in the market. But it really is all about oil. Above $105 a barrel in Brent, we're panicking again. Below 95, we're trading peace.
Mark, thanks for your thoughts. That's Bloomberg Markets Live Executive Editor Mark Cudmore there. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by going to MLIV Go on your terminal. Let's get to your stocks to watch now with Bloomberg's Charlie Wells. Charlie.
Good morning, Lizzie. Well, Mark was just talking there how it's all about oil, and we've got a kick start there, talking about a number of these European oil majors. I think one of the big questions in this higher price environment for oil has been, how do you differentiate between a lot of these big companies? We had an upgrade from Morgan Stanley to overweight for both Repsol and for BP here in Europe, and they had this interesting thesis that I want to bring up about how the oil market is unlikely to return to the regime that prevailed before the conflict. So upgrading these two names because of they're more high beta. They have more upstream exposure there, so they are more sensitive to prices. And Morgan Stanley talking about in their upgrade note on these companies, talking about how really the game has changed. Let's stay with that oil story, but go to a different sector. Airlines, again, these have been so in focus during this conflict. We really have some commentary coming through, some reports in the FT that Michael O'Leary of Ryanair is talking about how they are not going to hedge their fuel price prices until they see prices go down significantly. So we can see the turbulence throughout the course of this conflict, really from late February to March. You see a little bit of an uptick. Let's see if these comments on searching for that lower price filter through. But again, this industry really under strain. Ryanair, they're down, but not down by as much as a number of these names by Wizz Air, and these budget carriers so exposed because margins are so thin there. I want to talk about another upgrade story, and that is Novonesis. So that is the Danish biotech company. We know that Denmark is going to be in the headlines today because of that election. There'd been a lot of uncertainty, but we're seeing that incumbent looking likely to stay in power. That could change some of the bad vibes that we've seen in Norway. You see the overall index down. You see, of course, Novo Nordisk down, but Novonesis, the thinking here from Citi, it was a double upgrade, talking about how there's some structural change here that could be beneficial for a company that still is trading down in the market.
Charlie, thank you very much. Bloomberg's Charlie Wells with the latest there on some of the stocks that we'll be watching. He was talking about aviation. Let's linger on the theme of airlines. Bloomberg has been speaking to the United Airlines CEO, Scott Kirby. Let's take a listen to what he had to say about the state of play for that industry.
There will be less demand. There'll be fewer people traveling as prices go up. That's part of our cut capacity 5%. When airfares have to go up because of oil prices, there are going to be some people that choose not to fly, and it'd be naive not to realize that. If oil prices stayed where they are today, that's $11 billion of expense for us. And that would require prices to be up 20% to break even.
Well, I think the good news for Kirby is that they maybe have fallen a little bit since he made that comment. So we're down by 4.8% today in trade, Brent down by that much to just under $100 a barrel. But clearly this has been a big issue for the industry, the higher cost of energy. In terms of the shipping industry, we're getting some really interesting lines coming through, Lizzy. Costco Shipping saying that they are resuming bookings for some Middle Eastern destinations. I'm not sure if that means into the Persian Gulf, but it is interesting if we are going to see differentiated access for different nations' shipping, and that is something that the Iranians seem to be talking about with tariffs on access and also the types of countries that they will allow to send ships through. Yeah, saying non-hostile foreign ships can cross on its terms, but as we've talked about already, payments of up to $2 million a voyage. It's just not the sort of thing that Arab producers in the Gulf are going to get on board with. It's the weaponization of trade. It questions sovereignty. It sets precedents that they may not want to be set. Yeah, we'll see how that one plays out. Coming up on the programme then, our focus very much on the start of equity trading here in Europe. 7:54, so just a few minutes until we get what will probably be a positive start to trade. This is Bloomberg. Welcome back to the opening trade. A few minutes until the start of cash equities trading. This is the picture on US stocks yesterday. The yellow line marks where we were when Europe closed up. So this is what the US did after Europe closed up. Moved down a little bit, but all of that seems to be a little bit old news. The market increasingly weighing up signs of de-escalation against any signs of escalation, and it's the de-escalation signals that seem to be winning. So the futures picture looks really quite positive this morning, and increasingly so actually. This is more positive than it was just an hour ago. Up by 1.3% on Euro Stoxx 50 futures. FTSE futures up 0.8%. They were definitely lagging more than that earlier, around half an hour ago. And DAX futures up by 1.2%. So there is this sense that we're getting a very positive narrative being told by the White House, talking about winning, talking about the progress being made in the Iran conflict. We're also seeing talk of a 15-point plan that the Americans are going to be presenting to the Iranians, talk of when these meetings might take place. Could they come as soon as this week? So there's a lot of positive commentary coming certainly from the American side around what could be achieved here, and the market is choosing to focus on that rather than the disruption that has already been caused and continues to be in place, actually, Lizzy, for the Straits of Hormuz. Well, speaking of that disruption from the Middle East war, in terms of the stocks to watch this morning, we begin with Airlines and Ryanair's CEO speaking to the FT, saying that the airline plans to wait for long-term prices for jet fuel to fall. He says they'd be greedy and wait until hopefully they can get under $70. So mind the airlines. We also keep an eye on UK stocks. Will there be any reaction to that
UK inflation data that we broke at the top of the hour, bang in line with expectations, but of course it was in the weeks leading up to the Iran war. And then finally, EssilorLuxottica, of course, it is Meta's partner, the owner of the Ray-Ban brand, and Meta have withheld from the EU over battery rules and supply snags. So keep an eye on EssilorLuxottica.
We will certainly watch all of those, Lizzie, and really a lot of the overall market dynamics then all to do with one trade, and that is energy. It is oil and it is gas prices, both of those dropping this morning, so we would expect to see that have an impact on some of the energy names and a more positive impact on the energy consumers, of course. So we are out of the gates positive on the FTSE 100, up by around 0.5%, waiting for the other markets to open up, and they could open up more positively. There's a lot of focus on the energy story, as I say, and that seems to be taking a lot of assets with it. We've seen the European government bond markets opening in the last half hour and opening with those yields dropping once again quite substantially, reversing some of the move higher that we saw in yields in the yesterday's session. So certainly that will be something for yield-sensitive stocks we will watch as well. So the FTSE 100 then up by 0.7%, the CAC 40 up by 1.1%, and the IBEX over in Spain up by 1.25%. Lizzie, we wait for the DAX to open, perhaps one of the more beaten up markets, of course, around what's taking place in the Middle East, and we'll see whether that means a bigger turnaround today.
Well, in terms of the sectoral breakdown, surprise, surprise, when you've got Brent down 4.9% at $99 a barrel, the sector at the bottom of the basket today is energy, down more than 1%, but it's the only sector that's in negative territory today. The rest in the green. Travel and leisure leading the gains at 1.8%. Basic resources not far behind. Industrial goods and services, banks, retail, all up there. And just in terms of some of these energy names, if we dive into that sector, Total down 1.2%, BP down 0.9%, Shell down 1.4%. I had mentioned that we should keep an eye on EssilorLuxottica. They're up more than 1%. I mentioned Meta's rollout of the new display-equipped Ray-Ban smart glasses in the EU has been hampered, and yet EssilorLuxottica actually up this morning, along with this risk-on mood that we seem to be seeing at the start of the session here in Europe.
Yeah, and in terms of the best performers on the Stocks 50, we've got Prosus moving higher, up by 2.9%. We had a positive session in Asia, and some of the tech names doing pretty well. That can be something that pushes the Prosus share a little higher in the Netherlands. ING Group, Diageo, Safran. So in there we've got banks, we've got drinks companies, and we've got defence. So it's a mixed bag of some of the strong performing companies this morning. To the downside, to your point though, Lizzie, we see Shell and Total Energies as the worst performers. So there's a sense that energy not having its best day, but clearly it's obviously rallied a long way given the fact that oil prices are still just under $100 a barrel. 99.32 is where we trade on the Brent price. Let us get into the markets in a broader sense and talk to Natalia Lipakina, who's head of EMEA Equity Strategy over at JP Morgan Private Bank. Natalia, very good to have you with us. Thanks for being on the programme. I wonder how you're navigating the sort of conflicting headlines that we get around what is actually taking place with regards to Iran. So the US administration very confident of the progress it's making, talking about air supremacy, talking in President Trump's words of having won in Iran. Then we hear from the military spokesperson in Iran saying the US is negotiating with itself. The market seems to be focused on the intent from the US side and saying, well, even if it doesn't lead to anything in the short term, there is the intent there, and that to some degree matters. How are you navigating all these headlines?
Yeah, good morning. Great to be here. It's a lot to navigate. And when we look into the market, we still actually remain quite constructive on the market. We think that there is an upside risk into the year end. And that's our assumption. If I look in S&P, for example, we're seeing around 7,500 on S&P. And that is predicated on the fact that the recent geopolitical developments are actually a short-term headwind. Because I think if they are, then the market comes back to the fundamentals. Then the market comes back to, well, 2025 was actually a very strong year for earnings. And most likely, the earnings can stay very high in 26 and 27. We'll roughly pencil a double digit. But the key question here is how long oil stays at the current levels.
OK, so the key question is the duration. But if we did assume that this de-escalates, and that seems to be what you're suggesting with that call on the S&P, does that translate globally then? Do you also expect good things from European stocks and Asian stocks? Because arguably both of those more affected by energy issues.
I think overall that is positive for the global markets, right? But when you compare, for example, emerging markets over Europe, we actually prefer emerging markets. And we think that the recent pullback can be bought, because when I look into the fundamental, what is happening in countries like South Korea or Taiwan, they're positively impacted by the very strong momentum in semiconductors. So I think if we have de-escalation, basically, there will be more interest, again, in emerging markets. On the European side, we actually downgraded Europe earlier February because we thought that the market was pricing too much at that time. And I think the recent developments just showed that Europe is a bit more fragile and vulnerable. But overall, if we have de-escalation, that is positive for the risk on.
So you think there's going to be de-escalation, but the impact economically surely is going to outlast whatever's happening on the ground, and in terms of the central bank story. I note that you like banks when it comes to the sectors. Is it not too soon to be jumping back into banks when you've got tighter financial conditions already and perhaps further still to come, and all this worry about private credit?
Yeah, when you look into the bank sector, they actually underperformed quite a lot, especially in the US, on the worries that you just mentioned. But when you look and take a step back and look into the fundamentals, the loan growth in the US actually remains quite strong. So for us, and then you look into the shareholder returns, the dividends and buybacks, all in all looks quite interesting, especially given the pullbacks that we've seen.
OK. And then what's your view on the Mag 7, if we're talking sectors? Is now a good time to buy in the same way?
Well, I found it very interesting that since 27th of February, basically what you've seen is tech has been one of the leaders. Yes, it was down as the rest of the sector, apart from energy, but actually it outperformed in the relative terms. We think that tech is a very good opportunity right now, especially when it comes to semiconductors, because I think investors forgot that there is a huge capex cycle that is happening, more than 600 billion from those hyperscalers. So we actually think that those companies are quite attractive at this point.
Yes. And Natalia, so help us join the dots here, because at the same time as we've forgotten that there's a big build out around hyperscalers and around data centers and all the rest. When we were saying that in January and February, we were also talking about the energy demands that those businesses will have. And now we find ourselves in an energy crisis. So how do we get excited about the former without worrying about the latter?
Yeah, I think there are a few sectors that benefit from this trend. First of all, it's industrials, right? They benefit from the capex cycle that hyperscalers have, but also utilities. And if you look in utilities, the story is still the same. Supply is constrained, demand is still very strong, especially when it comes to the hyperscaler capex. So we think the utilities also is a sector that, investors should look right now. And also, if we have and continue to have a risk-off environment, utilities usually is a good sector to diversify into.
Today is a day when finally gold's broken out of its down streak, the second in a row, I think. We're up 1.6%. How do you feel about the gold miners? Because they seem to be splitting opinions.
Well, we prefer the metal over the equity. So we do like gold still on this pullback. I think the market was in general worried about what is happening in the market, and thus you saw such a big pullback in the gold. But we think that the recent pullback gives a very good opportunity to step into it, because ultimately, the metal still provides a diversification to the portfolio.
So what worries you then, Natalia, about... So I can understand lots of people talk to us about how they're going to assume de-escalation. What is the risk to your view? And should investors be protecting themselves in case these base case scenarios don't turn out to be accurate?
Yeah, the risk is if oil stays higher for longer. And I think, there are different scenarios that we can look into if oil stays 100, if oil goes to 140. But then I think there is kind of two different scenarios, which is where the market bottoms and where the market will be at the year end. And we think at this point the market is already starting to price the earnings risk. So for us, yes, oil is an important factor. But even if we have, for example, oil at 100 for the next half a year, for example, we still think that S&P probably will be higher by the year end.
Because the thing that struck me about your notes is that, you're very confident in the de-escalation. You're determined to look through the geopolitics. But surely this is a different scenario because it's not completely in President Trump's hands to de-escalate this conflict.
Yeah, and that's why we think that, yes, if oil stays higher for longer, then you potentially can have a short-term pullback. But I think what is interesting in the equity market is usually that is reflected through the multiple. So the multiple goes down first, and then the market thinks about earnings later. And we're already seeing, the pullbacks in the market. Yes, S&P was a bit better behaved compared to the international markets. But if you look into Europe and EM, we actually had already quite a decent pullback because the market was worried about those earnings for 2026.
If earnings are resilient, Natalia, is that just because analysts haven't quite caught up yet. They need some backward-looking data to perhaps take out to really substantially change those forecasts. Is that something that we need to be aware of?
I think so, because everyone is basically watching where oil is going and how long oil stays at the current levels. And that's why there is this fear, potentially, to change the numbers at this point.
All right. Nice to see you, Natalia. Natalia Lipihinka, Head of EMEA Equity Strategy over at JP Morgan Private Bank. Thank you. Let's check in on the core stakes, shall we? How are they shaping up on this risk-on day today? Green across the screen, as you might have expected, and particular gains for Schneider Electric there, up 2.4%. Rheinmetall up 1.8% today as well. Let's get a check on some of the individual stocks that we're watching as well with Charlie Wells. Charlie.
Lizzy, let's start with the airlines, because these have been so sensitive over the past few weeks to this crisis, to this oil price story. But we are seeing green across the board when you look at Ryanair, when you look at EasyJet and IAG as well. We've got commentary from a number of these executives, from Ryanair's CEO, talking about how, they're not going to hedge until they see the oil price fall further. You heard EasyJet executives talking about how they're going to have to pass the oil price increase onto the consumers. So the market liking what it's seeing as far as optimism on that front. Again, we've got an optimism story here today coming from Fresnillo as well. Let's flip the board and look there. Because of their exposure to gold, we see them up almost 4%. Now, gold has, of course, been an interesting asset in this story because it's usually a haven play, but it's been under a lot of pressure when there's been bad news in the market. That could be a rate story, right? Because gold, of course, does not pay interest. But again, seeing some of the optimism on the conflict, some of those positive headlines, that could be spilling into Fresnillo because of their exposure on the gold front. This is a company I love talking about next. It's ASOS, as seen on screen originally. This really speaks to the consumer, right? They have said that they had some really strong metrics as far as sales. They reiterated their guidance going forward. And look, we're up almost 10% here in London. This speaks to a consumer who at least has been confident. And given that reiteration, it looks like they're seeing at least confidence there in the budget clothing sector, which I am closely paying attention to. Let's flip and talk about biotech, because we've got some interesting stories coming through. We've got Novonesis. They are the Danish bioengineering company. They are up over 3% here. There was a significant upgrade there on the back of this idea that, in a higher oil price environment, you're going to need more bioengineering. That was an interesting take that we heard, and it's looking like that is really spilling through into the market. And then we've got Nanobiotics. Let's end there. That is that French kind of biotech company as well. There was a report in La Lettre that J&J was considering a takeover. So that is a report there shooting this stock up almost 9%. So some biotechnology news coming through, the market liking what it's hearing.
Charlie, thank you. Bloomberg's Charlie Wells with some stocks on the move, and some of them, Lizzy, moving on news that has nothing to do with what is happening in Iran or energy prices, which is interesting. So those other narratives cutting through. We also see that pre-market in the US, don't we, with the arms story certainly cutting through. So pre-market, the stock is up by more than 10%, and this because of what we heard yesterday from the company, a real substantial rethinking of what it is that this business does, where in the supply chain for chips it operates.
Yeah, a transformation, according to Neil Campling. They're going to start selling their own chips for the first time. It means that they can take on the likes of AMD and Intel, although the CEO, speaking to Tom McKenzie in San Francisco, saying there's room for all of us. It's going to be such a massive market that we can all play in it. But as you say, shares up in the pre-market stateside. We've also seen shares in SoftBank, which of course owns a majority of ARM, up in Tokyo on that news. Well, coming up, we're going to talk about private credit. Ares joining Apollo in limiting withdrawals from their funds. We'll have the latest on what's happening in the private credit space. That's coming up next. This is Bloomberg.
Welcome back to the opening trade. 17 minutes into a session that is increasingly positive for European stocks, increasingly negative for oil prices. We're now down with a 98 handle on Brent. Lizzy, we're just starting to get some lines coming through that give us a bit more detail on what this 15-point plan might look like. More on that a little bit later. But suffice to say, it is adding to risk appetite this morning.
Well, as we keep one eye on geopolitics, we keep another on private credit. Two of the biggest names in private credit, Ares and Apollo, have blocked investors from getting even half of the money that they wanted to get out of their funds, a sign of the mounting strain in that $1.8 trillion market. For more, we're joined by Bloomberg senior reporter Silas Brown. And Silas, we get these news lines every day, more and more of these redemption caps being introduced, that making sentiment worse, and then surely precipitating more and more of these headlines. I just think to myself, at what point does it become a crisis? Because surely that's the way we're heading.
Yeah, I mean, I think it's definitely becoming a vicious cycle where I think, as you point out, the kind of news then precipitates, follow-on redemptions. I think Mike Arrighetti spoke, the Ares kind of head, spoke yesterday and basically said he hopes that cooler heads will prevail.
Everyone says
point.
that.
And I think to a certain extent, look, I think to the defence of the industry, I would say that the withdrawal caps at 5% are there for a reason. I mean, the funds are structured, they're a liquid debt, and they're over 5 to 7 years. And if you halt redemptions or curb redemptions at 5%, that should match the liquidity that naturally comes out of the loan market. So I think in terms of it being orderly, I think that's okay. However, I do think if this carries on, it will just, it will become more and more concerning.
Yes. I mean, the cooler head, these are cool heads, aren't they? Putting in 5% caps when investors are asking for 11% back or something. That seems like quite a calming thing to do, or at least they're attempting to calm the markets by doing that, because, as you say, there are reasons for these caps. That's why they exist in the first place. Is it possible that this market stays calm, but because retail investors can't get their money out of there when they want to, they try to take it out of other, more liquid places? And it could be that there's calm in private markets, but not so elsewhere.
Yeah, that's interesting. And I would also say, what we're seeing in terms of, the stock markets and stuff like that, people are moving money out of the areas that people are moving money out of in private credit as well. I mean, this idea that AI is this kind of transformative technology and private credit is concentrated around areas that will be disrupted by it. And I think, you can see some resonance between the private credit market. So
it's weighing on listed BDCs, for example, in the States, business development companies that have lent to...
Yeah.
And meanwhile, at the same time, you've got inflows slowing. How much of a problem is that?
Yeah, I mean, I also think... one of the other points that no one's mentioning at the time, I think there's also a problem with deployment at the moment. I mean, basically, the deal making is kind of really slowed mostly due to kind of like macro geopolitical events, right? And so even if they could raise the cash, whether or not they could deploy it at the same rate that they were doing 2 or 3 years ago, I mean, I think is a very tall order. So at the moment, I think they're both being strained on the inflows and strained on the outflows, so to speak.
How does a higher inflation and a higher interest rate environment affect this industry, Silas? Because does that link to your point about deploying the cash?
Yeah.
What impact are we seeing from that broader narrative in markets on private credit?
I mean, I think, private credit funds are more opportunistic than banks, right? And so they can take a higher rate environment and be a bit more proactive about deploying capital, because banks will typically get a bit more cautious around lending, especially in the leveraged world, and so private credits can seize that opportunity, and they did that during the as rates rose through the Ukraine war and in 2022, and so there is a group of people in private credit that are believing that there may be more deal opportunities if rates go higher.
Okay.
Silas, thank you. Silas Brown, Bloomberg senior private credit reporter there. As we look at broader markets, Anna, risk on this morning as we keep an eye on the Middle East, and it seems like we've got some breaking lines on Iran.
Absolutely. So oil prices now down by 5.5%. So markets do seem to be moving on some of the detail that we're now getting. I'll say that this is all from AP. So AP is talking about some of the detail that could be in this 15-point plan that the people familiar with it have been telling Bloomberg does exist. So Iran has received that 15-point 15-point plan, according to AP. The US plan touches on sanctions relief and nuclear rollback. This, again, according to AP. They're also saying that it includes access to the Hormuz Strait, missile limits. I suppose none of these things are groundbreaking in the sense that these reflect the US talking points, the US ambitions that they've been talking about going into this conflict. So no surprise maybe that the market is leaning into this and sending oil prices a little bit lower. Let's talk to Anthony DePaola, who joins us now, Bloomberg's Middle East energy markets reporter, who is in Dubai. Anthony, talk us through how this is having an impact on oil markets. We see increasingly weakness in the oil price. Some of the detail that we're getting on this US plan, perhaps coming to the fore.
Good morning. The price has gone down below that ever important level of $100 a barrel this week, really. And there's been a lot of talk in the market about the jawboning from the U.S. government that trying to talk the oil price down with this good news. So we came into the week concerned that there was going to be reciprocal attacks on energy facilities like power plants, like desalination facilities, which would have been kind of one of the worst case scenarios in terms of escalation of attacks. We didn't see that. Instead, we saw this 5-day reprieve, which then has now turned into this 15-point plan and ongoing talks. We are hearing that there are some other talks going to come up potentially in person later in the week, possibly in a third country, possibly also involving the vice president and secretary of state. So these are kind of indications that this may be getting a little bit more serious, that some of the participants that are joining the group adding some weight and some heft to that. So the market is taking these as good signs, and that's what's driving the price down a little bit below that important level of $100 a barrel. At the same time, on the physical side of the market, we have Hormuz blocked. We don't have oil flowing through there. Iran is letting a trickle of cargoes go through that they choose, tankers to China, a few to India, and they're even charging some money for those cargoes to go through.
Exactly. Surely it's that really matters here. President Trump can propose what he likes to Iran. Yes, AP can be reporting that Tehran has received this proposal, Anthony, but who knows whether Iran's going to accept it? And we know that the president, in the art of the deal, likes to start with big demands, and then what we end up with could be something very different. Surely what we need to be focused on when it comes to the oil price is just how long the Gulf energy industry is going to take to recover from the Iran war and how long it's going to take for the Strait to reopen.
Yeah, clearly, what we need to see is some real actual progress in terms of reaching an agreement and in terms of getting that open. But as we're seeing in the oil market, people will look for the news that they want to see that's positive and latch onto that. For example, where I'm sitting here in Dubai, we've had a few more quiet days in terms of missile interceptions and noises that you can hear in the sky. The numbers of drones and missiles have gone down. And so people are looking at that as a good sign, saying, well, maybe they really are talking. We're feeling it on the ground here, that it seems like there's a little bit less of activity. But we're not out of it until we're out of it. So there needs to be these discussions that lead to a full reopening of Hormuz, meaning all vessels can go through, not just a select few and not paying tolls. That would not equate the free flow of energy supplies. And plus, the longer this goes on, we have the risk that it takes longer for facilities to ramp back up. Oil fields will need time to increase production. We've had producers shut in fields here because there hasn't been enough storage. There's simply nowhere to put the oil that they pump out of the ground. And a lot of the refineries as well that turn that oil into gasoline, diesel, jet fuel, those are export-oriented refineries. So even the refineries have had to slow their operational levels because they've got too much oil coming out. So what we really need to see is that vital waterway open up that allows the crude to flow and gives time for those facilities to come back online and gives time for tankers to get back to this region to lift that oil and get it out of this region.
Anthony, thank you for the update. Bloomberg's Anthony DePaola there in Dubai. And coming up on the programme, as Asia wrestles with that oil supply crunch, we'll speak to KKR's APAC infrastructure head about the effect on industry build-out. That interview next. This is Bloomberg.
This is the opening trade. 30 minutes into today's session, and European equity markets then heading decidedly higher. Something has been happening to the narrative around where this war is heading. Stocks Europe 600 is up by 1.4%. The Xetra DAX gets the best of the gains, up by 1.7% this morning, as we see stocks across most sectors in Europe in positive territory. I'll show you what's happening with oil, and we get a sense of where this is all coming from. We are considerably weaker on the oil price this morning, down by 5.8% this morning. I think we've been a little weaker than that as well, Lizzy. So we are weaker across the energy markets, and this all coming from some of the de-escalatory narrative that we have coming out of the White House, coming out of the US administration. President Trump talking about winning, putting out a 15-point plan, it seems, to try and get peace in, or to try and end the war in Iran. And I'm sure that markets very cognizant of the fact that this is not sufficient to end war in Iran, but maybe a necessary condition. So necessary but not sufficient, and it is necessary. So for that reason, it does boost risk appetite this morning. Lizzy, what are you seeing under the hood?
Well, to further illustrate just how much markets are latching on to this reason to be optimistic today, we've got 551 members of the Stock 600 higher this morning compared to only 44 lower today. Volumes are still down. We are still a little cautious about how optimistic to be here when we have so much volatility. But let's take a look at some of the leaders today. We've got Roche, aside from the geopolitics, upgraded to buy at Intron Health, so that's up nearly 2%. But on the geopolitics, Siemens Energy and Schneider are benefiting. Siemens up 4.5%. But take it to the laggards now. We've got Reckitt. It has been down over 20% so far in March, the worst month since 2000, and that continues today, down 2.6%. When we talk about energy, you talked about the lower oil price. You're seeing losses for the likes of Shell and Total today. Hence, as I last checked, energy, the worst performing sector today, Anna.
Here's some of the other news that we're focused on this morning then, Lizzy. The Italian Premier, Giorgia Meloni, has called on Tourism Minister Daniele Santanchè to resign after a defeat in a key referendum. The demand follows the exit of 2 Justice Ministry officials. It comes as Meloni attempts to clean house and stem the damage from the referendum loss to reform the governance of Italian courts. Denmark's Prime Minister Mette Frederiksen's party has won a closely contested election. The Social Democrats finished with just under 22% of the vote, their weakest result in more than a century. With no clear majority, the centrist leader Lars Løkke Rasmussen is set to play kingmaker after ruling out a renewed alliance was rejected by opposition leaders. The outcome sets the stage for complex negotiations as Frederiksen seeks to secure a third term in office. And the Associated Press is reporting that Iran has received the US's 15-point plan intended to help bring the war to an end. We understand the proposal was delivered to Iran via Pakistan, but the details remain unclear. Meanwhile, Iran and Israel are showing no signs of let-up in the conflict, with Tehran signaling little willingness to compromise and Israeli officials maintaining they will continue their offensive against the country. Lizzy.
Well, the conflict is at the top of global executives' minds as the war ripples out through the markets. David Luboff, head of APAC infrastructure at KKR, joins us now from Berlin. Good morning to you, David. You're there in Berlin speaking to clients and investors. What are the biggest concerns you're hearing from them there?
Well, good morning, Lizzy. Thank you for having me on the show. Yes, you're right. I'm dialing in from Berlin. I come every year to the infrastructure conference that's hosted here. I love coming to Berlin. And we are having very engaging conversations with the investment community. I would say there's a sense of calmness that our discussions are having. People are focusing a lot on the resilience of infrastructure as an asset class. This is an infrastructure conference after all. So we're spending a lot of time with the investment community talking about our portfolios, talking about the Asia region, and in particular the pipeline that we are seeing. But again, I think one of the key features that's coming out is the resilience of infrastructure during periods of volatility.
But do you expect that growth of KKR's Asia business in particular can continue when realistically you've got so much geopolitical uncertainty and we're seeing the pressure on Asian economies in particular from the energy shock? Can the growth be sustained at this pace?
Absolutely, Lizzy. I have never been as optimistic as I am today. I've been investing in the Asia-Pacific region for most of my 26 years of investing in infrastructure, and I have never seen a pipeline of opportunities as attractive as what we're seeing today. You know, if we take a step back, we've been operating our infrastructure strategy in Asia for 7 years now. Today, we've grown organically to $20 billion. We have 35 investments across the region. And what's really fueling that? It's the macroeconomics. It's the great opportunities that we're seeing in the key regions in which we operate. For too long, Asia has been underpenetrated from an alternatives perspective. Alternatives in Asia represent about 10% of GDP. Contrast that with the US at 25%. So we're in an environment where we've got very quickly growing economies, and alternatives really are expected to step up.
David, thinking about alternatives, it makes me think of the alternatives within the energy space as well. As you're rolling out investments in infrastructure in Asia, does the current war underscore a need for alternative energy sources, and is that an opportunity you're leaning into?
For sure. Renewable energy, decarbonisation, this has been a big key theme for us over many years in Asia. We have key focus areas: digitalisation, decarbonisation, and deconsolidation. Within the energy market, renewable energy has been something that we've been attracted to for a long time in Asia. It's one of our key investment themes. And I think what we're seeing today, to your point, the importance of domestic security of supply, the reliance on being able to not import fossil fuels and moving effectively from molecules to electrons. So for us, this is a fantastic opportunity to continue our investment in this space.
So alternatives in terms of the energy story can be a focus, David. But of the other opportunities you talked about, you say that the pipeline is looking really strong, and some of that comes down to the macro. But what if that macro story in Asia is challenged by these higher energy prices and by dependence on energy coming out of the Middle East? How can your infrastructure plays be entirely resilient to that?
Yeah, look, I think there's no doubt higher energy prices should have an impact on economic growth, particularly in Asia, where we are a net importer of oil and gas. So we recognize that. But again, if we take a step back, we are talking about a region that is home to 60% of the global population. The majority of the world's global growth is emanating from Asia. We have 3 of the top 5 economies in the region. So the structural tailwinds we think are so exciting. And then again, when I look at the infrastructure asset class, what has been proven over so many years is the resilience of infrastructure during periods of economic shock. So we are attracted to the long-term contracted natures of the cash flows. We are attracted to the essential services that we are providing to communities. And one of the features and one of the questions that we have been discussing here in Berlin is inflation and what impact that will have on our assets. Infrastructure is long inflation. Regulators allow infrastructure owners to increase their prices at inflation to protect real returns.
OK, so there's some resilience in that then, perhaps. David, thank you very much. Thank you for joining us. We appreciate getting your perspective. David Luboff, co-head of APAC and head of APAC infrastructure over at KKR. Coming up on the programme, the European Central Bank's Christine Lagarde is set to address the ECB and its Watchers Conference in Frankfurt. That's in just a few minutes' time. We will listen in live for comments on the economy and the impact of the war in Iran. This is Bloomberg.
Welcome back to the opening trade. We're 41 minutes into today's session, and you can see that optimism on the screen there. The Stoxx 600 up 1.4%. Outsized gains for Germany, but we're seeing gains around the world, already in Asia, and looking for gains in the US session as well. Coming back to the geopolitics, we've got oil lower, and it comes back to President Trump's push for peace in the Middle East. The US reportedly having drafted a 15-point plan, put it to Iran, and AP reporting that Iran has now received it. So at least one of the conditions to move forwards in this conflict, de-escalate, has been met. But let's look ahead to what else we're watching throughout the day, because of course we're still considering the economic impact of the war in the Middle East. We've got the ECB and its Watchers Conference taking place in Frankfurt. Christine Lagarde is going to be speaking any minute now, and we'll bring you her remarks live. Then at 9 a.m. London time, we have the German IFO business climate data. At 12 p.m, we'll hear from central banks here in the UK. The Bank of England's Megan Green will be speaking. Later on, we'll hear from the Fed's Stephen Myron. And then later on, after market, we'll get US earnings from Jefferies, Anna.
Let's bring in Skylar Montgomery-Coney from our Bloomberg Markets Live team as we're waiting for Christine Lagarde to start speaking at the ECB and its Watchers Conference. Then, Skylar, what are you watching from Christine Lagarde?
Yeah, I mean, I think it's very hard for Lagarde to generate a significant rally in bonds. And I think that's partly where the starting place is, right? We've already had her commentary last week. We know that they think there was enough inflationary pressure then to revise up the 2026 inflation forecast from 1.9% to 2.6%. And that was as of March 11. So since then, we've had more destruction to infrastructure. Energy prices have stayed elevated. And then I also just don't think it's really within her reaction function to want to have bond prices lower, right? The idea is they want to manage inflation expectations. There's not a reason why they would want to push back against hikes in this environment where energy prices are elevated. They don't know when they're going to come down. And the risk is very much the upside on inflation. So I think both the shift that we've had in terms of prices staying elevated, as well as just Lagarde's bias and what she wants from inflation, point to it being very hard to generate a bond rally from this.
We've got yields down across the curve, across the continent this morning. You're looking at the German 2-year down 7 basis points, the Italian 2-year down 10 basis points, similar for Spain and Britain at the front end. Right now. Let's see what Lagarde does to that. But you point out that commods are more optimistic than bonds this morning.
Absolutely. And now I think there's still a question over how optimistic commodities really should be. But as we've seen from last week to this week, we've gone from something like $120 on Brent down to 100. We've taken maybe 5-10 basis points off a German 2-year yield. Now, I think with commodities, we're getting conflicting signals in terms of, yes, there's wants of a peace deal of some kind from the U.S., but you're also getting more troops actually sent there. So big question from that standpoint. But I think with bonds, as I said, you're seeing more of a reflection of actual destruction that you've already had in terms of that inflationary pressure. The reaction function from central banks seems to have changed post-2022. And so that's really baked into your bond price. And I think that makes sense. And so you're going to have these kind of sticky yields unless you have a reason to think that there's enough demand destruction that overwhelms your inflation impulse and you don't need necessarily hikes from these central banks anymore, particularly in Europe.
I'm interested that we're getting lots of signals coming through. In fact, we're just getting some lines. Let's go to this show. We're just getting the lines coming through from Christine Lagarde's statement. So a lot of those just dropping on the Bloomberg terminal. And we'll go to the redhead. So even though she hasn't started speaking yet, we're getting the text of her speech. So the ECB won't be paralysed by hesitation on Iran response. Christine Lagarde is just walking up to the podium. It strikes me that chimes a little with what we heard from Hugh Pill about not talking about waiting too long, but we'll see whether that is indeed a parallel we should draw. Just looking at where we are on bond markets, as Christine Lagarde gets ready to speak, and we don't see a huge amount of change. Let's tune in to Christine Lagarde.
Thank you particularly for convening a family reunion. And, given that we are this family, I would like us to take just 1 minute to celebrate one member of the family who is soon going to enter his 10th decade. And I leave it to the economist and the number guys and gals in the room to figure out how old he is. But I would like a big round of applause for the first chief economist of the ECB, Otmar Issing. So, my dear Volker, if you had called this meeting a month ago, my speech today would have been entirely different. And the excellent economists and speechwriters and experts who helped me draft those wonderful words had to just delete everything that they had worked on and start all over again. And what's more, we had to update almost on an hourly basis. I suppose that's what you all do as well. So if it had been a month ago, the euro area economy had ended the year with solid growth momentum. Inflation stood last reading at 1.9% in February, and domestic growth engines looked to be strengthening, particularly private consumption that we had been anticipating, and investment, in particular in digitalization and defense spending. That was a month ago. Today is March 25th, and wars are raging. We find ourselves yet again in a different world whose contours are not yet clear. We are facing profound uncertainty about the path that the economy will take. None of us can resolve the uncertainty about how and when the Ukraine war will end and how the war in Iran will play out. But what I want to do today is set out how we will approach this last shock. And the main message I want to convey is that our response will be rooted in our monetary policy strategy that I spoke about in 25, as you mentioned. And I believe that it equips us well in order to navigate the shock that we are facing. Our strategy, if you remember, sets out 3 key principles, and they will guide us. Principle number 1, it requires us to assess the nature, size and persistence of the shock before taking a decision on policy. Monetary policy cannot bring down energy prices. That's obvious to all of us. But we must identify when higher energy costs risk spilling over into broad-based inflation, be it through indirect effects or through second-round effects via wages and inflation expectations. Principle number 2, it requires us to focus on risks, not only the baseline. Because the effects of significant price shocks on inflation can be non-linear, we need to work with scenarios and pay close attention to the early warning signs that the shock is embedding in broader inflation dynamic. Principle number 3, it gives us a graduated set of options on how to respond, which depend on the intensity and duration of the shock and how it propagates. Small, one-off and short-lived supply shocks can be looked through. But as expected deviations from our inflation target grow larger and more persistent, the case for action becomes stronger. So let's examine how we will be assessing the shock, and I'm going to do that with reference to what we experienced in 2022. Central banks and all of you have a long history of dealing with inflationary energy shocks, and over that time we have been able to build up a substantial body of evidence about when they risk spilling over into generalized inflation. In the euro area, the historical evidence suggests that the risk of broad pass-through from energy prices is the exception rather than the norm. When shocks are small in magnitude and short in duration, as has most often been the case, the inflation impact tends to largely stay within the energy compartment itself. But 2 factors can change that picture. The first factor is the intensity and duration of the shock. Our research shows that the relationship between energy price shocks and inflation can be non-linear. While small increases trigger no significant reaction in prices, larger shocks have disproportionately stronger effects. Disproportionately. The second is the propagation of the shock, which depends on the macroeconomic environment in which it lands. Firms are more likely to be able to raise prices when demand is stronger. Workers are more likely to be able to bargain for higher wages when labor markets are tighter. And both phenomena are more likely when inflation is already high. Our research confirms that pass-through is measurably stronger when capacity utilization is high and unemployment is low, and that wages feed into prices more forcefully when inflation is already elevated. An additional point. How people have experimented inflation in the recent past also matters. Research shows that lived experiences of inflation can have lasting effects on how people form expectations, with recent salient episodes carrying disproportionate weight. So, remember when the energy shock hit in 21-22? Several of these channels that I have just described were operating simultaneously. But there are factors today which point to a lesser pass-through. Let me take three. First, the initial shock has so far still been smaller. In 22, the shock was exceptionally large and persistent. Remember, even before the Russian invasion began, oil prices had increased threefold between October 20 and March 22, and natural gas prices by even more as Russia gradually throttled supplies. Then Europe was effectively cut off from a supplier that had provided around 45% of its natural gas imports and forced to find new suppliers in a disorganized way, remember? They had to compete in the global LNG market and build new import infrastructure. Oil prices peaked at around $130 per barrel in March 22, a bit lower than what we have, but in a similar range. But gas prices surged to much higher levels than what we have seen so far. 340 euros per megawatt hour in August 22 versus around 60 euros today. Second major difference. The macroeconomic background today is more benign. In 22, the economy was primed for pass-through. Europe was experiencing strong pent-up demand after the post-pandemic reopening. Supply chains were still disrupted after the pandemic. There were significant labor shortages. Headline inflation at the onset of the shock stood at around 5%. Our analysis confirms that this combination of factors exacerbated the inflationary effects. In particular, in the absence of demand pressures, the impact of supply-side shocks on inflation would have been considerably lower. There was a combination of supply and demand. Today, the euro area economy is in a moderate recovery phase without the pronounced demand-supply imbalances that characterized 2022. Headline inflation had been close to our target for almost a year. The unemployment rate is low by historical standards, yes, but we no longer face acute labor shortages in multiple sectors. Third, the macroeconomic policies are less supportive. When the invasion began in 2022, monetary policy was highly accommodative, with interest rates at minus 0.5% and ECB still engaged in net asset purchases. The fiscal stance was also expansionary, with an aggregate deficit of over 5%. Interest rates today are broadly at the neutral level, and the fiscal stance is neutral too, with an aggregate fiscal deficit of around 3%. Well, I will contend that at the same time, there are reasons for extreme vigilance. The International Energy Agency has described this as the largest supply disruption in the history of global oil market. And with the attack on energy infrastructure, especially the Ras Laffan facility in Qatar last week, the likelihood of a quick normalization is now diminishing. A further cliff edge, less talked about, is also approaching. Global oil reserves are being drawn down.